So let's talk about property prices and what's really happening with property prices and also with interest rates, because they're somewhat linked, not directly linked, but they are somewhat linked, especially now with how everything is gone. So the statement from the Reserve Bank says, and this is just released not long ago, so cash rate was unchanged, whenever that was, last week. And the other bit I highlighted, so the monthly CPI indicator was steady at 3.4% over the year to January. I'm just going to power through the highlighted bits. The first sentence, the central forecasts are for inflation return to target range of 2 to 3% in 2025 and to the midpoint in 2026. So this is what the RBA thinks. We'll return to this target inflation rate that everyone's been talking about for the last 3 years. It's going to return hopefully to some normality next year in 2025. I think it's going to be a bit earlier, but they think it's going to be in 25. And then the next bit, returning inflation, the next highlighted bit, returning inflation to target within a reasonable time frame remains the board's highest priority. So in other words, it's basically telling us if inflation looks like it's going to peak again, we're just going to raise interest rates until it comes back to 2 to 3%, reading between the lines, which I'm sure everyone probably knows by now. Inflation goes up, interest rates go up. So this is the monthly CPI indicator that we're referring to. So that 3.4%, when they made this decision last week, the February data hadn't been released. I'm sure they had access to it. So you can see December 2023, monthly CPI indicator is 3.4%. Then it's the same 3.4%. Don't know how they managed to fudge the stats to make it the same, 3.4% for January and now February. But that's where we're sitting at. So we're almost in that 2 to 3% bandwidth that they are targeting. We're not there yet. We still got a bit more pain left in the economy before we can get down to that. And people got to stop putting their prices up. So there has been some normality return back to the market. And these are the major changes. Now, this is to January. I didn't update this, didn't get a chance to update this with February. But this gives you an idea on where this inflation is coming from. And apparently, breads and cereals are 7.4% up. So the highlighted ones. Food products, 6.9%, 7%. And tobacco has gone up by 10.7%. That's a contribution to the inflation rate. Then you have a look at housing rents. You're probably not surprised by that, 7.4%. In a lot of capital city areas, actually more than that. New dwelling purchases by owner-occupiers, 4.8%. And then the losers, which is good, prices are coming down. Holiday travel and accommodation, hooray, because that all just about doubled after COVID when everyone was traveling. So holiday travel and accommodation is going down, luckily. And the other one that's going up is insurance and financial services, probably with all the flooding and everything that we've had. Gives insurance companies an opportunity to bump their prices up and redo their maths calculations to make sure that they make their billions of dollars of profit from us all paying the premium. So that's where the inflation contribution comes from. So the headline inflation forecast looks like this, and this came from the monetary policy paper released just last month. So you can see it's on a downwards trajectory. It sort of matches what the RBA just said. They expect it to be in that bandwidth in 2025. So they've been a bit wishy-washy about where this could be. It could be the blue, so it could go up, it could go down further. So we don't know. We're all just trying to speculate on where interest rates are going. But all data sources point to one direction, and that is down. So that's a good sign for us. And then this data website also forecasts, which is Trading Economics, also forecasts that in quarter 3, quarter 4 this year, which I tend to agree with more than the monetary policy paper, is that we'll be below 3% inflation. So inflation expectations will tick below 3%. We're already at 3.4, so we're nearly there. We only just got to wipe another 0.4, 0.5, and we're sub 3. So I think it could happen at the end of this year, and I think that interest rates probably won't move until the RBA starts to see consistent inflation below the target, because if they start putting interest rates down, chances are people will go and spend money and inflation will peak again or spike. Then if you have a look at the United States, their inflation is very low. Now, I know United States is not the Australian market and they operate differently, but we do have a lot of ties to the United States. And they look like all data's pointing in the one direction as well, which is down for them. And then if you have a look at Other places around the world, they're all looking like they're all coming back down, which is great news. So we're all coming back down together. Australia normally, or has been traditionally, behind the US. So look to the US for a little bit of some forecasts on what's potentially to come for Australia. All right, so that again is from the monetary policy paper released by the RBA last month. So policy rate expectations all headed in the right direction, which is great. Then you got to have a look a little bit at unemployment. It's still pretty steady at 3.8%. At least it's gotten, I shouldn't say that, but it's gotten a bit worse since we bottomed out at whatever the bottom was, low 3%. So some normality is, if you have a look back at the graph between like 2014 and 19, you can see the unemployment rates like around about 5%, 6%. It's pretty stock standard. So whether we're going to get to 5 and 6% unemployment in the next couple of years is a question on everyone's mind. Hopefully we can keep inflation within the limits and not have to shed a whole lot of jobs. Then you have a look at the forecast for where unemployment looks like it's going. So it looks like it's slightly trending upwards. We might get to 4.5% unemployment rate. So there's some jobs left to be shed. And that's based on monetary policy paper as well. Then looking at some RBA stats. So I'm going to flood you guys with a whole heap of stats, and I will decipher them to tell you what I think these all mean in the market. Everyone's going to have their slight different opinions. But if you have a look at new loan commitments, we're lower, definitely lower than the peak, but we're still tracking okay. But you've also got to consider now we're in 2024. So have a look back into, let's say, 2018, 2019. The loan commitments were similar. If you have a look at the top numbers, and I'm just going to pick out New South Wales and Victoria because they do make up a significant part of the market. So pick those two blue lines that you see on the screen, have a look back a couple of years, and you'll notice that it's around about the same. But one thing that hasn't been considered, or that you have to consider, is that property prices generally across the board are going to be up 30, 40, whatever that number is, percent. So technically for us to be at the same loan commitments as we were 3, 4 years ago, we technically need to be like another 30% higher in terms of those loan commitments, which we're not really, with the exception of, if you look at Queensland's graph, that gold color, that's still up a bit, but that's reflective of property values, whereas New South Wales and Victoria are not. So our loan commitments are still pretty low, and that's probably not surprising to you because it is a lot harder to get a loan now than it has been over the last few years. And I think it's going to remain a bit harder to get a loan because of serviceability requirements, because of the bank's criteria. You need a lot more money now to be able to borrow money from the bank. But I think towards the end of the year, once we start to come out of this credit squeeze that we're in, and the banks confirm and the RBA confirms that the interest rate cycle has peaked, then that lending is going to be more freely available. So we're probably towards the end of the year going to see this start to spike up. But I think between now and the end of the year, it's probably going to remain pretty level. So once the banks start changing their policies and they start lending money more easily, then people go and get loans. It's pretty simple practicality of how this, like what the data feed is into this set. And then obviously that builds momentum in the market. It has that crowd effect where everyone jumps in and then the market starts rising generally overall. Then we see more people getting loans because properties are going up and everyone wants to be a property investor. So that was for that was for owner occupiers, this graph, just one comment. And this is for investors. So investors are hot in the market at the moment, or they're a lot hotter than owner occupiers. You can see the top two are Victoria and New South Wales, which I'm actually a bit surprised by that they're going up as well. Queensland is going up and WA is also going up. WA is going up probably more from interstate buyers than local buyers. So you can see all of those trends are all on the upwards trajectory. And that's for investor housing. Owner occupiers are pretty flat. Dwelling approvals by type, we're at a really low dwelling approval number across the country. I'm not going to go into each individual state. I've looked in particular at Southeast Queensland because that's where I'm developing. And in Southeast Queensland alone, the last 3 years, we have an undersupply of 30,000 dwelling approvals just in Southeast Queensland, to give you an idea. So we are tracking, or we are about to experience an even lower level of construction and building off the back of the approvals. So you've got approvals in one hand, and then those approvals need to get built. And there's a lag time between approvals and then the actual construction. So if approvals are low, which we're seeing here, it means that construction over the next 6 to 12 months is going to be very subdued, which is not great for our economy. We're likely going to shed jobs in that industry, or at least free up a lot of people. So it's going to get a lot easier to build a property. We're going to have builders pricing more keenly. The materials are not going to go through the roof like they have been. Labor is going to come to some normality, as in the cost of labor to build a house. So that's coming. But then on the flip side, we're bringing in a lot more people, and that number, and this is to September 23, we're bringing in a lot more people, and unfortunately, we actually need to build more stuff. So we're going to have an even bigger problem than what we already have with vacancy rates and with people trying to find rental properties. So these numbers are from September 23. These are the latest numbers, which were only released, I think, at the start of this month. So you can see the total growth, 660,000 people. And then the net overseas migration makes up a significant portion of that. And all the other people having babies makes up 111,000. So this has come from the ABS, Australian Bureau of Statistics. And what that means for annual growth from basically capital city or state to state is, if you have a look at New South Wales, and these are just the overall numbers. So you've got the light blue is a natural increase, the dark blue is a net interstate migration, and then you've got net overseas migration as the gold color. So overall, New South Wales gets 185,000 people, most of which go into Sydney and surrounds. Victoria gets 195,000 people. And these are latest stats for the last 12 months, by the way, till September 2023. And then Queensland, 145,000 people, closely behind. South Australia gets 30,000. Western Australia gets 90,000. So they are the annual population growth that we're currently tracking on. It might be a little bit softer in the next 12 months if they ease back on migration, but that's what we're tracking at the moment, with pretty much the lowest building approval level we've had in the country for over 10 years. So it's a bit of a scary time, and it is going to be scary for the next 12 months with finding properties, and also finding properties to live in, but also finding properties to actually buy, because there's going to be not that much available because we're not building enough. The other part of the equation is, with property prices, is actually savings ratio, and with interest rates, how much are we actually saving? So in the last little bit, because interest rates have gone up, everyone's put more money onto their loans. The savings ratio has dwindled right down to 1%, as you can see there, or just over 1%. And it's forecast to climb or go up slowly. And when interest rates do start to come back, which I think will be in the back end of 2024, hopefully, they might get bumped into 2025 to start reducing interest rates. But once that starts to happen, obviously our savings ratio will go up. And also with some subtle wage growth, in other words, we're getting paid more money, that'll slightly increase over time as well. So this is what the forecast is. We'll get back to some normality maybe next year sometime. We might get back to the levels that we saw before everyone went crazy over COVID. So we had this big spike, and then we had everyone spend money, and now not many people are sitting on a lot of money. So now we're going to get back into that savings category. So let's have a look at, and I'm going to show you a graph on the next slide about distressed